On January 20th, 2026, there was an executive order signed, and it was about Wall Street being stopped from buying single family homes so they don't compete with Main Street. Well, that's a pretty bold promise. So, here in this video, we're going to go over who the winners are, who the losers are, and most importantly, what it means for your money. My name is Rob Gillespie, and for the past nearly 30 years, I've been involved in the real estate investment and private capital space. And let me tell you, let's break this thing down to what it actually says before we start freaking out. First off, what it really means is the government has stopped the financial backing for the financing for these large institutions to go out and buy multiple single family homes. It's very ambiguous saying that they're going to force them to divest in what they already own, or what is a large investor? Is a large investor 10 homes, 100 homes, 1,000 homes? That's the scary part. It hasn't really been defined yet exactly what that means. So really, let's talk about this for a second. This sounds great for political theater to say, okay, we're going after Wall Street. It's a great talking point. It's going to make headlines in the news. But how many homes are these guys really buying? So when you really look and dive into the institutional buyers out of Wall Street, how many homes they're buying, it's less than 1%. It's actually about 0.7% of how many homes they're actually out there buying. Now, out of the rest of the people buying homes, 25% are bought by investors just like us. People like you and I, we're out there buying. So there's 25% over here of the faceless investor. But because that has a name and a face with it, they have targeted the Wall Street guys. So I'm not real sure if that's what's it's going to do for them to take away a 0.7%. But let's look at it here. What's it actually going to mean for who's winning and who's losing in this? Well, first off, the potential winners in this is going to be the 25%. It's going to be us. Because now when we go to an auction or we're looking on the MLS or off market deal or whatever it might be, we can go back to being the big bidders in the room again. So whether you have your own capital or you're using capital from someone like us, you can go in there and bid. Which before, these institutional investors were paying so much for these properties, it didn't make financial sense for us to go in there and bid against them because there's not a lot you can do with it if you're paying those numbers and it's your own money. Now, because of that, I think the biggest loser in this situation is going to be the tenant. The people that are in the situation where they have to rent, it's going to hurt them. And here's how I think that. Let's begin by saying when an institution buys a home, I hate to bring this up, but they're probably better landlords than we are as individuals because it's not their money. It's institutional money. It's government-backed money. At least it was. So not only will they pay top dollar for these properties, they will also go in and put all the capital expenditures in they need. Where you or I might look at a stove and fridge and say, well, it's good. It'll last the next 5 years. That roof is fine. It'll last 2 more years. They're like, nope, we don't have any problems. Everything's new. Everything's going to be perfect. So that's great. They go in, they make these things amazing where we're probably not going to do that. And so we're going to have a subpar housing situation where it's not going to be quite as nice as it probably would have been with the institutions. Again, just my opinion on things. Now, what else is going to happen with the tenants is when they're out of the market and we're boots on the ground here, the 25% that are buying these properties and buying more of them now, it's going to be more competitive for the rents on that for the tenants. They're going to have to compete more for it. So anything that we don't grab up as individual investors will be grabbed up by homeowners. So it's going to tighten the market up there. Now, the whole reason for this is to help homeowners. And how's it going to affect the homeowners? And I don't think that's going to be a positive or negative because this is a national law that's been signed in an executive order. And nationally, I mean, it might mean something, but this is such a special localized problem. So you're going to have areas in the Sun Belt, like, Charlotte, where you're going to have more institutional buyers there, where it's going to affect the market more than it would in different parts of the country. So I don't think it's going to directly affect the homeowners because of that. So now let's talk about the unintended results of what all this means. Here's what is unintentionally happening. So think about these massive build to rent communities. And I don't know if you see them in your town, but you don't have to go too far, especially in the Midwest, to see a big tract of land where you have these ranch style apartments going in, hundreds of them, and they're surrounded by hundreds of single family homes. These are all built to rent. That's it. It's all institutional money building to rent these out to get a good cap rate. That's all it's for. For people are putting, these 401ks and retirement plans, teacher pension plans, all that. That's all going into that because it's a very stable new build. Those are going to go away because we need institutional money to build that. Because your average, investor out there in the country, they're not going to take the risk or raise the capital to go out and build something so massive. So what's going to happen if those dry up, then there's less roofs being produced. That's going to increase the demand for rentals. And then some of the homes that would be going onto the market for homeowners will not be going to the market because our 25% will be grabbing up to make them rentals. So I'm not sure that's going to help a lot. And then you go take that to the builder section where the builders, yes, they're building spec homes to sell to homeowners, but they always have that secondary exit clause. It's that secondary. It's kind of like we were wearing belts and a suspenders. So the belt would be that, yeah, they're going to sell them to the homeowner. The suspenders would be, well, I can't sell to a homeowner, so I'll take these 10 homes. I'm going to package them up and I'm going to sell them off to an institution that they can keep them as rental properties. Without having that exit strategy as a backup, you're going to have builders become more reluctant on starting a project. If they don't start a project, they build less homes. Again, less inventory, less roofs, and increased rents. So that's not going to help there either. And then there's the one part that I guess it's going to, let me get my tinfoil hat on here real quick. So what's it really all about? Is it really about trying to stop Wall Street from buying homes? Or is the FTC and the Department of Justice, are there things in that bill, which there are, where they can team up and they can look for problems in the process with the institutions or the big buyers? And they can look at, are they price fixing? Are they deliberately leaving vacancies? Are they doing certain things? And it's really just a way maybe for big government to push themselves into the single family housing market. I don't know. That's my hypothesis. You heard my opinion on this new bill. So go ahead, put some comments below, put some questions. I'd love to open some dialogue on it. I'm not sure, but it's going to be interesting to see what happens next.